Welcome to your presentation for understanding the income statement. What is the purpose of the income statement? Well, a hospitality business receives revenues, so that's the money that business takes in and incurs to provide a service, okay? Or to provide a room, to provide a plate of food. That's the money that we pay as guests. They also have expenses. So that's the cost of the items that are required to operate the business. So in order to make that money, we have to spend money so that we can actually operate, right? Any money that's left over, so dollars that remain after all expenses have been paid, represent your profit. But let's always remember, it could also equal your loss. Now, we want to make sure that we understand some terms, and one main term, especially for you SAILI, it would be profit center. So each individual revenue generating segment within a business is called a profit center. Now I say USAILI, but it could be USAR as well. It could be a restaurant. A local restaurant like Lone Star does very good business in their dining room and bar, but they also do a lot of business from their takeout. So those would probably be two different profit centers that they would have on their income statement to try and analyze where the money is coming from and how they're doing in each department, in each profit center. Okay. It's fairly common in hospitality situations too to have some part of their operations that generate costs but no revenue or that operate at a loss. So if you think about a hotel, administrative is typically your section that runs at a loss because there's no revenues that come into your administrative department. They still have a departmental schedule, but you would see no revenues, all expenses. Therefore, that is running at a loss. Your room service is another department within a hotel that will often lose money. Now, all stakeholders who are affected by a business's profitability will care greatly about the effective operation of a hospitality business. So owners want to know how the company is doing, if it's healthy, if they're making the owners money. Investors want to know whether or not this is a company they should invest in, so they want to buy shares of that business or not. Lenders want to make sure that there's enough cash flowing through, and they would like to compare potentially one accounting period to another. Same thing with the creditor. Will you have enough money to pay the lenders, so those that are lending you money, and creditors, so those are purveyors, people who are supplying you with food, suppliers, that you don't pay right away. You are on credit with them. They want to know that your business is healthy so that you can move forward. And then as managers, we need to be able to analyze and to see where we may have done very well or where we could be doing better moving forward so that we can continue to be a healthy company, a healthy hotel or restaurant, financially speaking. When an accurate income statement is used to provide information, all stakeholders can make better decisions about how best to develop and operate the business. So these would all be stakeholders. So people that are affected by the operations of this business, they can all make a better decision. They can all know more about the company if income statements are prepared properly and ethically, so with accurate statement. So who prepares these financial reports? So it really depends on the type of operation. So a smaller operation, you're going to see an owner or managers. So that would be really your independent operation that's not too big. The second you get to a larger restaurant chain, you may have a centralized accounting office. So you may have one corporate office where financial data is taken from your point of sale system, your POS, and sent off to the accounting office. And then they prepare that unit's income statement or all the unit's income statements. As soon as you become a bit too big, you start to do a lot more business. It becomes a lot easier, a lot more consistent when it's all centralized in one place. And your corporate office would want to see how each business is doing on a daily, on a monthly, on a quarterly basis, all those different accounting periods. When we get to very large restaurants and lots of hotels, you often have professionals who work on site mostly. Each hotel would typically need your accounting section, your finance section, that prepare the statements, that go through everything in-house. They're very closely related to the hotel operations, so because there's so many different departments, by being on site, you have a better understanding of the hotel itself and all the finances that take to run it. Same thing with very large restaurants, but typically it would mostly be for your hotels. So to prepare an income statement, there are some principles we need to follow. So the income statement needs to clearly identify the business whose revenues and expenses are being summarized. So at the top of an income statement, whether it's USAR, USALI, or any other income statement, we should be writing right away the title of the business. It should plainly state the specific accounting period for which the statement has been prepared. For the month ending, and then the last month. For the period ending, you really need to be clear about which accounting period we're looking at. Are we looking at the quarter? Are we looking at the month? Are we looking at the year? And which part of it? So if it's month ending, which month? If it's quarter ending, which quarter? So you need to plainly state so that it's very clear to people which accounting statement, which accounting period we're looking at this data for. It includes a summary. So in the most informal and detailed manner, all the revenue generated by the business during the accounting period. So that would be our first lines, or revenues that we've looked at when we looked at our financial statements, the key statements. We need to make sure that we outline the revenue generated by the business during that accounting period. It will then summarize all the accounting period expenses. So remember, revenues first, then expenses, in order that were used to generate the stated revenue. Income statements need to utilize a logical and consistent system to classify expenses. This can be set by management to make sure which way they want those expenses to be listed. That's your undistributed expenses or non-operating expenses. You want to utilize a logical and consistent system. Okay, so what some businesses will do, they'll make sure that the expenses are listed in order of how much, the ones that you spend the most on at the top. So you want to make sure that you're always following a consistent way. And this is for your expenses that are not your cost of sales, not your directly related operated expenses, all your other expenses. You just want to make sure that you're consistent. Your income statement needs to provide additional clarity via the use of schedules where appropriate. So with USALI, we have our departmental schedules, but we also need to make sure that we are making notes within income statements if we need to. What we can do at the bottom of some income statements is make a little note and explain something. Let's say for a month, if we were to compare last year's January to this year's January, well, this year in January the weather was much worse. We had 4 days where we were closed because of a flood. Anything like that should be mentioned within an income statement as well. This may explain some of the discrepancies, or maybe something that really did, why a company did much better this month at this time compared to last year. So it's always good to add some notes as well. And then it incorporates the use of a uniform system of accounts if applicable. Guess what? For hospitality, it is applicable. Remember, uniform system of accounts for restaurants, USAR, uniform system of accounts for the lodging industry, USALI. So it is applicable, so the income statements that you prepare in restaurants or hotels should follow that uniform system. And then the format. A big thing about format is we need to make sure that negative numbers on an income statement are designated one of 3 ways. Okay? By a minus sign in front of the number, by brackets around the number, or by the use of the color red rather than black to designate the loss amount. You will occasionally see a combination of the brackets and written in red as well. Okay? But it needs to be either a combination or one of these. Okay? That's why we say operate in the red or operating in the black. If you're operating in the red, it means that you are operating at a loss. You are losing money on your income statement. If you're operating in the black, it means that we are making money. Okay, we are having a profit. We're experiencing a profit. Get used to these terms as we move forward in this class.